Good morning and happy Monday. It's Monday, May 5th. I'm here with my colleague, Jenny Rae. My name is Namaan. We are the Chief Operating Officer and Chief Executive Officer, respectively, of Management Consulted. And we're back for another episode this morning of Market Outsiders. There's a lot that's happening in the economy right now. There's a lot that's happening in markets right now. And so what we do is we get together every weekday morning for about 15 minutes. We pick one story that we think is meaningful to the broader population, meaningful to you, that maybe isn't getting the run that it deserves, in traditional media. And so today, what we're going to do is we're going to talk about the role that emotions play in markets, and we're also going to talk, I believe, about oil prices and what their effect are on the broader economy.
Is
And
that the
so
royal we, Naman? We're
that's
going
going
to
to be
talk
the
about
royal
oil
we
prices.
because I'm ready to talk about emotions, and I think you did a deeper dive on oil prices. So if you want to talk oil, I'll be ready tomorrow. But I'll give you the floor today and let you say whatever you want. And then I want to get into a little bit about how the markets aren't purely rational. I think that's one of the when I talk to people, when I coach people, one of the things that I often hear them say or believe is that the markets are purely rational, and so the market must always be right. That's not necessarily true. And so I wanted to talk about how this is a really human endeavor that we're talking about, economies, markets, et cetera, and how being self-aware around your own emotions is really critical to long-term success. Before we get there, Jenny Rae, you want to talk to us about what you're seeing in the oil market, and then we'll move over to my segment.
You bet. So, good morning, everyone. Look, I think that the day that Naman agrees with me on everything will be the day that this podcast gets canceled. So, I'm not worried about having a full agreement on these conversations. But we advise CEOs and leaders of businesses that are not necessarily looking at equities trading. They're trying to run operations that are usually in the private markets. And so, one of the things that they ask us about when we advise them on things like communication or data analysis inside their business, about future-proofing their organizations, about leadership and management, is not about what the stock price is or should be, or the big trajectory of how to get there, but the little changes that make a difference. And so that's kind of the premise of this. And I think that oil prices are one of those kind of things that make a huge difference. And I want to just harken back to a conversation that I had when Trump was picking the Treasury Secretary. And somebody texted me. We are not on the same side of the political aisle. And they said, hey, what do you think about this? And I said, look, I don't know everything, but I think that they've got one thing right, which is that if we see a lot of volatility in big pieces of the market, if we see consistently falling oil prices through an increase in production, you're going to balance out volatility, especially from tariffs. And so that's why I'm nerdily super excited about an announcement that came out over the weekend that I think a lot of people might not pay attention to because they don't recognize how many sectors of the US economy and the global economy this impacts. So I'm just going to talk a little bit about oil prices and how we got there. So I'll just read the headline kind of like I usually do, and then Naman, you're going to be able to weigh in on this. The deep dive is not necessary, but right. What headline is: Wall Street points to losses and oil prices tumble on OPEC plus decision to open the spigots. So I think that it's really important, first of all, to understand that those are not the same headlines, right? Wall Street points to losses and oil prices tumble are two different headlines. But really, this is an increase in production decision by the OPEC cartel. And specifically, I'm just going to read a little bit further because so it said US benchmark crude oil fell as much as 4% overnight, but recovered somewhat by early morning, declining 94 cents to 57.35 per barrel. When I was at Bain at this point 20 years ago, we priced oil per barrel at up to $65 per barrel. So it's pretty remarkable that oil has actually fluctuated, of course, but gone back below the prices 20 years ago where we were. Brent crude, the international standard, lost 83 cents to 60.46 a barrel. But this is really the big key, right? During the weekend, the OPEC plus group of 8 oil producing nations announced it will raise its output by 411,000 barrels per day as of June 1st, stepping up production increases. So the prices have changed based on futures contracts, and the focus is just on simply an increase in supply. And because oil is one of those things where if you have more of it, people don't necessarily buy more. You see this kind of positive cyclical effect in an economy. When the prices start to come down, people begin to plan for an increase. So you see travel prices fall, right? You see airline prices fall. You see people maybe taking an extra vacation over the summer if they're able to afford to do that. But probably more importantly, oil impacts a lot of industries that people don't think about. It impacts the entire plastics industry. It impacts roads, right? Oil is one of the largest components of like roads and infrastructure building. It impacts the building industry, significant impact inside there. And when you see these other industries that have seen real price increases in an inflationary period affected by these lower numbers, then you see a real positive change. Also, Naman, the thing I want to throw to you before you go over to yours is I want to ask a question because it goes on to say the group said strong fundamentals were behind the decision. I don't think so at all. And then they go on to say, right, analysts speculated that it might reflect a desire to curry favor with US President Donald Trump. He's making a visit to the Middle East later this month. What do you think, right? Why is OPEC all of a sudden, after, I mean, it's been years since they've seen a production increase like this one. Why this month? Why over the weekend? Can you tell us a little bit about what you think?
Yeah, I think partly it is due to the timing of the president's visit. I think bigger picture, they're trying to take share from American producers. So when I hear oil prices are going down, I'm like instinctively, I'm like, oh, that's good news because I'm a consumer, right? Oil and gas is probably the sixth or seventh biggest like individual economic sector in the world, and every single sector that's bigger than it relies on it. So it's in a really great spot just in terms of like its place in the global economy. But when oil prices go down too far, then the next thing that I think of are some of our clients that are in the energy space and in the oil and gas space, and how, there's a sweet spot of like a price of a barrel of oil where, it stimulates economic activity, but it retains American energy dominance. And I think right now what's happening is that we're slipping below the sweet spot. And what I think one of the maybe unintended effects of this price decrease is going to be is that it becomes unprofitable for us to continue to explore, continue to drill, and continue to produce. And so what you start to see is that other parts of the world start to take share from us in terms of oil and gas production. And so, I know one of the political goals of this administration was to drill, baby, drill, right? And when oil prices go down too far, there's no incentive left to drill, baby, drill. And so I think one of the things, and I don't have a take on this in terms of what's better, right? Like, so I'm not here saying I think oil prices should be higher. All I'm saying is there are unintended consequences maybe of something that initially seems really good. Well, yeah, wouldn't we want oil to be as cheap as possible? Well, yes and no, right? Because where do you want to get your oil from and who do you want to incentivize to continue to produce more? And so, hey, I'm glad that it's going to be cheaper for me. I'm in Texas, gas is cheap here anyways, but it's going to be even
Hey,
cheaper for me to.
gush about that from California, man. I am not
Yeah.
interested in hearing about your Texas
So,
braggery.
so I'll take $2.20, a gallon at the pump. I'll take, cheaper plastics. I'll take, positive effects, even in like industries like pharmaceuticals that you wouldn't think rely on oil and gas, they do. And so, I'll take those cost savings kind of, transferring down the value chain in all these different industries. But then I'm also thinking about, okay, are we incentivizing producers and drillers to like pull back? And then how is that going to affect us the next time that oil prices rise? And so that's the balance that I think of. So to answer your question, Jenny Ray, I think what they're doing is beyond kind of extending an olive branch to the president. They're looking to take market share from U.S. producers, and that they're maybe even willing to take a little bit of a loss to do that.
I love that, Naman. I think we should roll over to your emotions commentary now. But the last thing that I just want to say here is that I think that if I had to kind of pick a sweet spot for the economy, one of the things that I look at when I look at the impact of tariffs is not tariffs in isolation. I look at the counter impacts. And so we look at things like interest rates. We look at things like labor markets. We look at things like, in this case, I think that oil prices are really significant. second. And I look at the whole package together. And I think a lot of people don't look at the fundamentals. They look at the momentary news of the day and they panic or they press pause or they kind of do whatever else they're going to do. So I think there's an important tie-in to what you're going to talk about today. But for me, when I track oil prices, there's something that are not backward looking. They're actually forward looking
Mhm.
because there's a futures market on them. The labor market doesn't have that advantage. So this is one of my fundamentals that I look at when I'm looking at the health of an overall economy.
I think it's a great leading indicator, and I think one of the dangers of you know looking at oil futures in isolation is that you can actually take two or three different insights from the same numbers. So like
Correct.
it would be also reasonable to say, hey, oil prices are dropping. It's like a potential sign of a slowdown. Because when you anticipate that demand's going to go down, what are you going to do? You're going to start to drop prices. And so, why is global demand going to drop? Because there's going to be a slowdown in economic activity. So, I think it's reasonable for you to look at the same numbers and say, "Hey, that's like a bullish sign or a bearish sign." And it really just depends on kind of the lens that you come to the situation, looking at it, looking at the situation through. And so, we're not here to give you one take or another. We're just here to tell you we think that this metric matters, and there's multiple ways that you can interpret it. And so if you're only listening to maybe one interpretation, you're missing out on a lot of other insight that you could be gathering. And if you are making business decisions, if you're making investing decisions, you want as many perspectives as possible before you move. So, and I think that does tie into what I was going to share about really, really quickly, which is just that understanding the power of emotions when you're examining an economy or examining the markets is incredibly crucial. If there's two emotions I had to single out that drive economic activity, it would be these two. It would be fear and it would be greed. And so when you look at the markets, when you look at the economy, I think you start to see these emotions at play. And the more that you can be self-aware about your own fear and your own greed, the better decisions you're going to make as a business owner, the better decisions you're going to make as an investor. And I think one of the things that I've just learned through a lot of reading, through a lot of observation, through my own examining my own behavior over time, is that markets aren't purely rational. They're moved by collective emotion. Like they reflect the psychology of millions of individual investors. They reflect the psychology of hedge funds. They reflect the psychology of business at large. And so when all you do is follow the crowd, follow the herd, that's when you find yourself in, asset bubbles. That's when you find yourself in crashes, when everybody's moving in the same direction, maybe regardless of logic or underlying fundamentals. When they're just moved purely by emotion, when enough people are moved like that, that's when you start to find yourself in bubbles. That's when you start to find yourself in crashes. And so I really pay attention to the emotions that I'm feeling, because I understand that emotions put blinders on you. They give you cognitive bias, right? So when you feel the pain of a loss more intensely than the pleasure of a gain, right? You feel that emotion of loss aversion that you can start to then chase gains that you shouldn't, right? You can start to make business decisions based out of that emotion. You when you're driven by emotion, you can fall into the trap of confirmation bias. You can fall into the trap of FOMO. You can fall into the trap of recency bias. What brought this conversation up for me is that there was an article in the Wall Street Journal this weekend that said that the average retail investor spends 8 minutes doing research on a particular stock before they pull the trigger and buy it. 8 minutes. And
Do
out
you
of
feel
that
like that's
eight
high or
minutes,
low, Naman? Is that high or low?
I think that's incredibly low. And out of that 8 minutes, most of that time is spent looking at the price fluctuations of the stock over the last 24 to 48 hours. So it's not analyzing the business, it's not analyzing the fundamentals, it's not even doing like a further back analysis of like the price movement over time. It's just this is a snapshot of where the stock is now. Looks good, I'm going to pull the trigger. Sometimes that can work, right? But I was just blown away that the average person would just spend 8 minutes to make what often is a pretty meaningful financial decision. And so recency bias plays a big role in how a lot of individual investors make decisions. And I think it plays a big role in also how a lot of business people make decisions. When we go in and we work with organizations, we work with businesses, one of our jobs is to zoom back out to 30,000 feet and say, okay, this is what's happening right now, but how does it connect to what's happened further back? And how does it connect to where you want to go moving forward? Let's get out of your emotions, at least for a couple of minutes, and see if we can look at the bigger picture. And so kind of just to tie this all up, my sermon, if you will, for today, because it's more of a sermon than an economic analysis, is just that emotional control leads to longer term success. We saw this last weekend. Warren Buffett decided that he's going to step down as CEO of Berkshire Hathaway at the end of the year. He's going to hand over the reins
I
to a
can't believe we
successor.
weren't there this year, Naman,
I
right? I
know
can't believe we weren't there. We were there
we missed
last
it by a
year.
year. We were there last year. It's
Mhm.
the Woodstock of capitalism. By the way, if you've never been, highly recommend it. But I think one of Buffett's hallmarks, right? One of the reasons he's on the Mount Rushmore of investors is that he was able to stay calm when others panicked. And he found his greatest opportunities. He had cash waiting on the sidelines. And when everybody else was panicking, he swooped in kind of against the emotional tide of the day and acquired amazing businesses at incredible discounts. And we could have a conversation, January, another day about if that's even a viable model for today or not. But in Buffett's time, he was able to use his mastery of his emotions to move when everybody else was paralyzed. And I think that's one of the biggest hallmarks of his success. And it's something that I've tried to emulate in my own life, both in investing and in business.
I mean,
So
Buffett only spends 8 minutes looking at his companies, though, right?
yeah, absolutely. So maybe
He's
8 minutes
he's
an
famous
hour,
for yeah, exactly. He's famous
taking
for spending
years.
12 hours a day
Yeah.
reading about individual sectors for weeks and months before making a purchase decision. So yeah, completely counter to not only the emotional model but also to the practical implications of that. I love it.
So
Tie us up,
anyway,
Naman.
well, I just wanted to say I think our segments, even though they seem unrelated, they actually are related. In that I think there's multiple ways to interpret the oil price news. And I think if you're driven by emotion, right? Like if right now, if you're feeling fear in this environment, you're going to interpret that news one way. If you're seeing opportunity and feeling, greed in this environment, you're going to interpret that news a different way. And so I think it's just self-awareness is key as you look at markets, as you look at economic indicators, to know what you're feeling so that you can take yourself out of that and take a look at metrics and what's happening in the world a little bit more objectively, and that'll help you make the best decisions.
If you've got questions for us about the markets, economic fundamentals, they may be things that we know. We may have to go tell you how we figured out the answers to your questions, but we are opening up the channels both for market insiders here on the chat. If you want to pop any questions in that you've got, we'll keep those going forward for the future. Also, you can join us at the same time, same bat channel right before the markets open at 9:15 Eastern every day. Look forward to seeing you soon.